welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with Jim Riggio. Today we're going to talk about pre-FOMC and pre-election, as Jim said, mostly pre-election hedging. But before we do, a quick disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss of trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this is for educational purposes only. So, with that out of the way, let me pop into, this is the right PowerPoint, right, Jim?
Yep, I'm pretty sure it is. If you go to the next slide.
All right, let me see, where's the old presentation thing, slideshow, here we go.
And go to the right second slide is just the disclaimer that you already read. Oh, no, now we're seeing your yeah.
It's got it on the wrong screen. All right, well, I'll tell you what, we'll just do it like this if you want, or unless I can reshare my screens, but it doesn't really matter.
Either that, or if you can, try to just make it as big as you possibly can. Get rid of the top line, with the icons. But go to the next slide, and while you figure that out, go to the third slide, and I'll start to end up going.
Wow. All right. I'll just keep playing with this.
Okay.
So.
This is the slide I want to have up. Okay. For those of you, I did a hedging, just a general hedging seminar or WebEx with Paul Demers last week sometime, that if you haven't seen it, it'll end up going through the basics of hedging, some of the things that you need to end up taking a look at. There were some things that were going on as we go into the election that I kind of wanted to end up covering with everybody. The first one is, and this is a question to everybody. I want you to end up chatting in here. What do markets hate more than bad news? Anybody, go ahead, type it into the box. Exactly, Eric. The markets, and Alexander, the markets dislike uncertainty more than they dislike bad news. Bad news they can deal with because it's a defined quantity. When we end up going into a event like earnings or an election or any type of vote where we don't know what the outcome will be, and the outcome is going to be perceived to be very different if one result happens versus another, the markets won't know where that uncertainty comes from, and that'll end up being a big issue for them. So you have to kind of go back and take a look at it. It's been requoted many, many times. I think the first person said it was Edmund Burke. Okay, those who don't know history are doomed to repeat it. Okay.
Yeah, we had that quote in our fighter squadron. It was from Santayana. Those who cannot remember the past are condemned to repeat it.
And Burke lived during the 1700s. So Santayana sounds like an older name.
He probably, Santayana, he probably copied it and repurposed it.
Or vice versa. Many people have since. But it's really true. You kind of have to know history. And here's the thing. You don't need to just know the outcome of the history, but you need to know the details of what happened and why. Why is so important. And so what we really need to do is that we need to end up gaining insights. An insight on those things like the elections, okay, where we have a known uncertainty, okay. It's not like it's a surprise, okay. It's not like all of a sudden something we weren't expecting. We know it's coming up, so everybody knows it's there. So how do we end up dealing with that? If you go to the next slide, the event risks that we end up having is obviously in a couple of hours, less than 2 hours from right now. The Fed's going to end up having their announcement on the rates. Next one is on December 14th. I'm going to end up showing you, okay, why those things are basically non-entities in a minute. But when you think about, okay, what can possibly end up happening, those are the first two that, kind of end up have been scheduled for a while. The biggest thing is the elections and what's happened. I'm not a registered. I am a registered voter, but I'm not registered to any party, right? So I don't talk politics. All I talk about is odds, percentages, and how it's going to end up affecting my investments. The odds had been, if you were going to go to Las Vegas or to a high street bookmaking shop in London, the odds were you're going to have to lay about 5 to 1 to end up betting on Clinton. Those have been reduced dramatically. So that's about an 80% probability that she was going to end up winning. I saw one, odds maker that had brought it down to 60% today. The odds have changed dramatically. Also, something that probably has even more fear is what happens if the Democrats have the presidency, the House, and the Senate. That ends up having some risk that people end up seeing also. And so when I take a look at this, we were going along and the markets were kind of happy because the probabilities were that Clinton was going to be in and the GOP was going to end up holding the House and Senate. And that has changed more and more. And so we have these other uncertainties that aren't just yellow lights. They're either flashing red or solid reds for the markets because they don't know how the markets, what would end up affecting. That's what we're hedging against. Okay. If you go to the next slide, this was a leftover slide, from the previous presentation that I just wanted you to end up realizing, hey, what are you trying to hedge? Are you trying to hedge your portfolio? What assets? Okay, do you mind taking, a 2% loss or a 5% loss? What's your deductible? How much do you need to end up insuring if it does go out? Are you looking to insuring your entire portfolio? Are you just trying to insure your road trip trade or your M3 or your Kevlar? Those are things that you'd have to end up thinking. And then also, how much does it end up costing? Now, here's the problem with this. The market has changed dramatically. Go to the next slide. The data on the implied volatility is that we can end up going and we can look at what the IV is on every single point, right? Those are just data points. Okay. From there, what we need to do is that we need to end up putting them together, do some relative analysis of where one data point is to another so that we can end up understanding the data points and put it into some type of information, okay, that we could end up using. But you really can't stop there, okay? You have to be able to have the insight to understand what's happened before, learn from history, understand the possibilities of what could end up changing, and then be able to end up taking all of those data points and saying, how do I end up actually putting a hedge in place that I want? Some people end up taking a look at the VIX is going up. I got news for you. The VIX is going to end up going up every day between now and the expiration, so it's practically a certainty. And here's why it's a certainty. The VIX is a formulaic. Well, it was a certainty a couple of weeks ago. Now it's dependent, but it was definitely a certainty 2 weeks ago. It's a formulaic, which means that the SIBO guys, had got together and they took some group of options near the money. Okay, they used some type of an aggregate formula to be able to pull in multiple data points, and it's a 30-day moving average of IV. That's what it is. It's a single point. So as the election got to be closer to 30 days, say from 35 to 25 days, more and more of these data points were going to come in, okay, where the IVs would be the options that expired after the election versus before the election. So what ended up happening is that you had IV kind of end up doing this, dance in and around when it was on both sides. Okay. What's happened now is that all of the 30-day options, okay, are after the election. So that's where the uncertainty is, right? What happens afterwards. Now, what ends up happening is that because the probability of who's going to end up winning has changed over the last month, okay, Clinton was getting stronger, now she's getting weaker. The volatility is going to end up changing. Now, when I say the volatility, the devil is really in the detail, okay? You have to take a look at where the volatility is going up. Not that the IV is this or this month is more than that month. You actually have to go in and look. Okay. And when I used to end up doing this for professional advisors, they used to end up calling me up and say, Jim, I need another session for you to read the tea leaves. Okay, and they used to call them the option tea leaves. So what I'm going to do is I'm going to show you how to read the option tea leaves. There's three components to this. Okay, the first one is where's IV overall. Okay, so you look at the VIX, you look at VVIX, you look at the futures, you look at container rate. Those are the broad-based stuff that you can just look at and get an overall picture. Doesn't give you the details. The details are you have to go and take a look at what the implied volatility is for strikes above and below the money and at different strikes. You also have to take a look at how the volatility either goes up or changes as you look for more and more duration, meaning the further back options will end up changing what the implied volatility is. Okay, with that, Tom, I'd like to end up taking the ball. So if you'd give it to me.
No problem.
Okay, and so what we're going to take a look at first is I can look at a bunch of different things, and let me just close this and give me 1 second to be able to get here. So I can end up taking a look. I'm not going to end up wasting your time looking at the VIX or the VVIX. I mean, you guys can end up doing that if you want. I'll look at it really, really quick. Let me do a share desktop, and let me share the correct screen. This one. Let me come over to charts. Let me end up just detaching a chart so that okay. Let me bring this chart up here, make this big. And I've done this before for you guys. Okay, so here's the VIX. Okay, I don't want to look at the VIX for multiple periods of time, so let's just take a look at what's happened this year. You can end up seeing, oops, let me go back to over here. Let's take a look at here. Okay, as you guys remember, this was back in the August timeframe that killed people, a year and a half ago. You can end up seeing what ended up happening in January, February timeframe. You can see what ended up happening here going into Brexit. Okay, you can see what ended up happening going into Brexit. The same thing happened, by the way. Here's the history part so that we're not going to be doomed to relive it. The polls all said here, good, business as usual. We like to have power the way it is. And so when the polls were saying that the UK was not going to leave, okay, the European Union, everything was fine. Then all of a sudden, some polls said, uh-oh, it looks like it might pass. It shot up very, very quickly. Now, it's going to shoot up more quickly in the UK because we don't follow politics in the UK, or the US markets don't as much as they do here. What's happened here is that we've popped up in volatility. Why? Because the thing is that the polls are saying that the certainty that it looked like Clinton was going to end up winning still looks very certain that she's going to win, but it's not as certain as it was. Therefore, there are some issues. There's also been a lot of discussions in and around the House races. Could the Dems take back, the House? Having all of the power with one party, the markets never like, because the government will kind of just do what they want to end up doing, and they'd rather see it do nothing, right? It was Ronald Reagan, right, who once said, I think, the 9 scariest words in the English language are, I'm from the government and I'm here to help. So the markets, usually regulations, if can get passed, that are very lopsided when one party ends up putting their views on everything, and if they control the House and the Oval Office, it becomes more challenging. Okay, so we end up having that. Now, one of the things that you'd also end up taking a look, and I mentioned this, is that I look at VVIX. I think VVIX is a better way of taking a look at things because what it is, it's the volatility of the VIX options. You can see here that we've kind of popped up somewhat too. This is what really killed people back, a year and a half ago. So we end up seeing this, and so it's a general picture. It doesn't say very much, right? So, you can end up seeing it. This is not the picture. This is not the whole picture. This ends up giving you just a sliver, of what you actually end up needing to know. What you're looking at here. Oh, let me do this first. Let me come over to here and show you guys why I can't use this. And I'm trying to get it to move, and it's what's happening is that I am moving ever so slowly because of I have so much stuff open. So let me end up bringing this over here so you can end up seeing. What I wanted to end up showing you was Thinkorswim, and here's why I don't use Thinkorswim to be able to end up showing this. It's they end up having the skews, and I'm going to close everything. And as you come down here, you take a look at product depth. Right, I'm on the Analyze tab. Take a look at product depth. Here's the skew, so I can try to end up doing this. Okay, let's take a look at. We're looking at options. We're going to look at just the out of the money, so we have one graph. We're not going to look at all 33. Let's just look at the pre and the post election, and then let's go with the monthlies. Okay, and here I have way too many strikes, so I'm not going to look at. Oh, I didn't save. I'm sorry. Let me do that one more time. Sorry about that, guys. Uncheck. Let's look at the pre and post elections. And then we'll end up coming over and looking at the monthlies. Okay, and I can hit enter. Oh, I did the same thing. I'd say, I didn't realize that that's what it was happening when I was collecting. I thought I had to click there to get out of it. There we go. And instead of looking at all of the strikes, we don't need to look at options, so we can make this look a little bit bigger. Let's go and take a look at just maybe, I don't know, 100 strikes. So here's at the money. I can see that because of the out of the money and the in the money end up going. If you take a look at this big long one over here, this you actually have to end up checking over here. That's going to be January. So it's tough to end up seeing specifically what's where, okay? I can see the implied volatility goes up. Now, normally what ends up happening is that once I get below the money, the skew at the below the money, okay, options. And the reason why I call it that way is that the reason why we call this a put skew is not that I'm talking about what's going on to the left of the at the money. We call it put skew because we go from upper left to lower right. Yes, you end up having, as Paul Demers likes to call it, the belly of the curve over here, which I think is a great name. The reason why we end up going up is because the IVs at this point, the cost of the calls are so cheap that adding a nickel to these things actually will end up increasing the volatility. But for the most part, we go from upper left to lower right. This does not end up giving me any actionable information. This does not give me any history. I can't see anything from this. Therefore, I really don't like using, okay, the Thinkorswim stuff for that. The reason why I end up using the live vol stuff is what you're looking at here is 10% above and below the money, right? So it cuts everything off nice and neat. I don't have those tails that I have to end up thinking about with the previous graph. I'm only going to look at the first 6 months. I'm going to look at options over 25 cents. So therefore, anything that's really, truly nickels, they're not going to give me good information anyway. So let's just get rid of them. I'm looking at this on the SPX. Okay. Now, what I purposefully did is that I went a couple of weeks before Brexit, and I'm going to want to end up showing this. Now, this is interesting because I can look at this way. If I end up rotating the graph, it's a three-dimensional graph, so I can see where the implied volatility is for each of these. Now, normally when I'll do this myself, I'll end up selecting just, the 2 or 3 months that I want to end up seeing it. But I want you to be able to see this and see how everything ends up changing. Here's the color code. So what I want you to end up focusing on, though, okay, when we end up doing this, is that the vote was on June 23rd, okay, UK time, which means we weren't going to have results until the 24th. So we have an option that goes on the 24th. We have an option that goes on the 29th. It's the yellow line, and you can also see here, it's that greenish color line. You can see that right here. And as I can play this, I'm going to start on the 8th, okay, and I'm just going to end up going day by day. Okay, and I'm going to end up seeing how things end up moving. Now, you can see what ends up happening here. You see how these things popped up? They popped up because the thing is that we're looking on the 13th, and this is the day before expiration. And so what happens is that the implied volatilities, this is something that you need to know. These are the tea leaves, okay? This is the history that you need to end up knowing all the time. In general, what will happen is that as you get closer to expiration, and just the way gamma gets much bigger, as in that last week's expiration, these curves will change dramatically as you get into expiration. And you can see how much steeper they get below the money. Just to reiterate here, here's the current price at 20s, all right? And you can see that where we are. And you can see below the money, you can see the price to the left, okay, going down to 18.95. You can see the price going up to 23.15. And so if I end up playing, and by the way, if I don't want to keep hitting it day by day, I'm going to hit play, and it will end up actually, once it loads up, it'll end up actually playing this through me day by day. You can end up seeing, and because I have so many things, it might be a little bit jittery, but I can see where the date ends up going, and I'm on the 16th now, and I'm going to hit pause. Look at what ended up happening. I have to go back 2 days. I have to go back a couple of days here. And so if I go back on when the polls first came out, where things started to change, and I think it was either the 19th, maybe a little bit earlier, what you'll see is that the implied volatility, here we go, from the 17th, you can see the implied volatility was 33 down here at the bottom. Now look at these curves over here. They're not nice and flat. Look at how this curve, which expires before expiration, is almost a straight line. Here we're starting to get a bump. Do you see this bump? Where I know that Paul and his trading group, they call it that the line's gotten pregnant, right? Because there's this big bump over here. And so if you take a look at how this portion of the curve has started to end up expanding or getting larger or higher than the rest of the curve, this is because the election's coming up, there's uncertainty, and institutions are going to try to buy insurance. Now, where are they going to try to buy insurance? I don't have any idea. Okay. Where have they bought in the past? Well, it depends on how fearful they are. Okay. And what's happened here is that they say, well, I can afford to end up losing maybe, 2, 3, 4%, but I want to have protection going on there. It's not that expensive. I'm just going to buy short-term protection to get through the election in case anything ugly happens. So I'm willing to end up paying more here. Now, will the implied volatility be even higher below the money? It always is. But if you take a look at the shape of the line, people are saying, well, what's the skew? Well, my response is going to be, what part of the skew? What are you looking at? Because if you're looking at this portion right here, let's say from, and you see it, hold it, from 1950 up to, 2025 or so, that's pretty flat. If you looked at what the skew was from, say, over here, and if I hold a cursor, let's call that, 2050 down to 2100. Well, that's a much steeper line, and I'm looking basically at the steepness of the line. And so how flat or how steep the skew is totally dependent on where you're looking. This is the devil in the detail. This is how you read the tea leaves and seeing what the market's thinking. Okay, because it's all there. You can take the data points. You can map them out. You can go back and look at history, and you can get your information, and you can get insight out of this. So people are afraid. Now, what ends up happening is that the first day that the polls come out where they say, uh-oh, it looks like leave might end up beating stay in the Brexit vote. If I end up moving another day, you can see that we end up going from the 33 up to like 44. You can also see that that bump is still here. You can see that everything else started to end up moving up right after that. Now, remember, this expires on the day of Brexit results. Okay, so it's going to have a much higher volatility versus if I end up going a week or two, or well, not a week, or week and a half behind, you can end up seeing that these lines also moved up. And if I keep playing this, okay, remember it's on the 23rd. Here's the 21st. 23rd, by the way, is the vote. That's a Thursday. And so the results will be out on the Friday. Here's the 22nd. By the way, since I'm only looking at a quarter, I don't have a lot of data here, but you can see what ended up happening here. I still have that bump. It's very pronounced. All right. The 23rd comes in. Now, but Ryan, I don't know if you guys remember, I don't expect you to end up doing Because I was in London, okay, at the time, I was reading a ton of stuff on it. And what ended up happening is that basically going into the vote in the last couple of days, the stays thought that they had it locked up. Okay. There was a high probability that they thought that it was going to end up going, and it turned out to end up being really a referendum on immigration, which they didn't end up counting. And here's 23rd. You can see what happens on the 24th. Now look at where the curves are. We still have this big bump. Right, and on the 24th, you can see basically we even get higher, we get steeper, we're starting to get a little bit flatter. Why? Because the thing is that more everybody's just scared, crapless at this point. They don't know if they're going to end up towing England out to sea and sink in it. And then what ends up happening is that right after, by the time we have the sell-off on Friday and then on Monday the 27th, and we're still dropping, people go, oh crap, how bad is this going to end up getting? I better put in my short term. I need to reload my insurance to end up getting more insurance in case we really tank. And so the shape of this curve ends up really changing. It really changes. Okay. That was our history lesson, so we're not doomed to repeat it. Okay. So you can see what happened in an election because there's similarities to where there was certainty that they were going to stay. The polls ended up changing somewhat, and then they ended up changing back from stay to they were fearful of leave. Then they thought in the last couple of days it was going to be still a stay, and then we ended up having surprise, and the markets ended up selling off, and you know how ugly things got. One of the things that I'm going to hit play while I just end up talking about this. One of the things that we need to end up taking a look at, and you can see in those graphs that I was showing, is that the implied volatilities for what ended up happening both before and after Brexit was a huge difference. You can take a look. And we're going to get to this as we're just playing through the skew curve here, right? One of the things I can do is I can also end up moving this to any point. I can end up just clicking and bringing it over to here. It will end up taking some time to end up because, again, it's just got so much data and I have so many things open. Okay, here we go. Here's what I want you to see. Okay, this is right now. Okay, this is on the 31st. Okay, we're going to end up playing it the last 2 days. Look at the same bump that we have here. Take a look at the aqua color line and the dark blue color line. So we're looking at November 9th and November 11th. You say, wait a second, Jim, how come the implied volatility isn't higher right now? We have a Fed meeting that's coming out at 2 o'clock. Shouldn't the options that expire today or maybe by Friday or definitely by Monday, shouldn't they be higher? Well, look, here's the red line. You can see that. Look at how low that implied volatility is. Okay, the yellow line is a little bit lower, and the green line is down here. The market has no fear about what's going to happen with the Fed meeting. All of the fear in the market right now is around the election. And this is not my opinion. I mean, this is the information directly from what the options are telling me. And so when people end up asking me, well, how fearful is the market for this or that? The answer is, I don't know. And that's why, some of the professional money managers that I've done consulting for, they're like, okay, I need you to read the tea leaves. That's how I can end up seeing. I can also see the same thing ended up happening. If I go, 2 weeks ago, I can tell you that this line was totally flat. Okay, right after the election. Okay, one of the things that I'll end up doing is that, and let me just get rid of these 3 lines. Let me keep up until November expiration, and then let's get rid of everything to December. And then we'll also get rid of everything until after January, just so that it cleans it up a little bit. It's easier to see. And this is the way I would normally end up looking at things. And do I have my 16th and 18th? I wanted to look at those. And then I wanted to end up looking at the December 16, and I want to get rid of the rest of these. Okay, so what I can end up seeing over here and it's just a little bit slow. Okay, and I want it January. Okay, so what I can see here is that the longer term ones are relatively flat. They're steeper, Okay, they're normal, but they're relatively flat in terms of the shape of the line. There is no bowing, okay, or right. We've gone from basically a linear line to something that's more quadratic. It's a curved line. Okay, and this again is going to end up being because there's fear in the election of where we are. So one of the things, and here's another question I guys would like to respond. Anybody who trades an M3 style trade, a Kevlar style trade, a road trip style, anything that is a butterfly with a center point below the money. How have you done the last 2 weeks? Have you lost money? Have you made money? Have you stayed flat? Have you made less money than you expected? And Tom, I don't have my stuff open, but I already know the answer to this one. But it's
Yeah, my road trips are going down with the net liquidation, but it's still
yes, they
in good
are.
shape. Is still in good shape as far as the expiration, but temporary losses.
Well, here's the whole thing: temporary losses, but you got this huge unknown between now and expiration, and you're not going to hold the trades to expiration. So what do you end up doing here? Okay, everybody else, I assume that you've done the same thing, right? You've lost money. You've lost money, and many of you have lost money. I would say the majority of you have lost money, and you don't know why. Oh, you're going to end up saying it was skew, okay? But do you understand the details of why that is? Tom, I can end up using mine, or I can end up using your road trip. Do you want me to use my trade, or would you rather me take a look at one of yours that you currently have on?
Oh, yours is fine. You've already got the ball.
Okay, so here's what I'm going to end up doing. I'm going to end up showing you my trade grid. Let me come over here, my risk profile. Okay, this is my November trade. Okay, broken wing. Actually, it's not a broken wing. It's unbalanced. Okay, because if you measured the wings, they're the same size. And I know you guys, okay, watching this on replay, are going to hit pause and try to end up dissecting it. So let me help you. Okay, you take a look. Each wing's 100 points wide. This side is steeper than this side, which means I have more contracts on this side. I will tell you that I've peeled out of most of what I end up having here. So all I have is one. This is what I have remaining. I have one vertical on this side and two verticals on that side. So what happens is that let's take a look at our strikes. We got to look at the 2150, the 2050, and the 1950, right? Those are the only strikes that matter in November to me, okay, in the world right now, because those are the ones that I have open. Everything else is theory. I don't care. Okay, you have to end up doing this at home. So let's come and take a look at the Novembers. And I forgot what's the expiration date. Is November 16th, right? Not the 18th.
Yeah,
the monthly.
16th.
Okay. So let me get rid of the rest of this crap. Okay. And so here is the 16th. Okay, what we currently have open. Okay. I'll leave December open because I also have a December position. And I don't have anything in January, but I'm going to be looking at January. Okay. So we need to look at the 50s, right? 2150, 2050, and 1950. So if I come over to here, take a look at where the 2150 is. It's not in the bowed portion of the curve, right? It's definitely at the point where it's already gotten a little bit less steep here. If I take a look at the 2050, which is going to end up being right about there, it's at the more bowed portion of this. And now remember what's happening. If I just click on, let's say, something here, a little bit closer, what you'll end up seeing is that you'll see it's more pronounced with less time to end up going. So it's going to continue to end up, being like this before the election. It's not like it's going to get better. So this area is going to continue to end up being pushed up a little bit. And then my 1950 is way down here at the bottom, and it's not as high in implied volatility, right, in that straight line. So think about what happens to my Kevlar. One, my long strikes have a lower volatility than compared to my center strike if it was on a straight line. Hence, when implied volatility is higher, it's going to make the price of the option higher. Since the price of the option is higher on my short strike, That's why I haven't made as much money as I would have liked. Okay. Now, I assume that you guys know that you lost money, but um, that's that's the reason behind it. You know, how many of you guys realize or do dissection of taking the data points, looking at the information in and around your options, okay, your trades, and then end up understanding and gaining insight from what we just went through? That's the type of if you know, when I take a look at how do you end up learning from experience, okay, of knowing history, being able to dissect your stuff and then understand and realize what's going on. This is how you end up hedging. Now, what I did, okay, and I'm not looking at the questions, Tom. I moved the chat over, so I see that there's a bunch of stuff in there. But what I ended up doing was that a couple of weeks ago, I started to scale out of my Novembers. I still have it on. I still have a small piece on it. And yeah, I'm frustrated because, and also what I did was that I didn't leave it on evenly because I didn't want to have my long call, okay, end up skewing things. I needed to get risk off, so I had to end up breaking it down. I only had, okay, if you end up remembering, I only have $6,000 of the $50,000 at risk. You can see that right here. Oh, by the way, I also have my $5,000 of profit at risk. So, you know, in some ways, yeah, my margin off of when I started the trade is only $6,000, but I could lose 11. That's why you never count your profits until the trade's over. Okay. So when you take a look at it, that's what I did was that I scaled out of most of it, banked my profits, tried to make some more money, okay, on this thing, because where I was when the market was higher, I thought, oh, I'm up here. Well, if it comes down, I should do well. And I played all the skew games, and it still didn't work. Basically, I have been stuck, okay, not making any money for the last 2 weeks on this thing. In fact, I probably am down about 0.5%. I was probably up at one point a little over 11%. Now I'm only up a little bit over 10. So I've given back some of my money. I don't want to give back anymore. But so my plan, okay, in this is where we are is that I'm going to do one of two things. For, you know, my conservative guys and for my what's going to happen in the Kevlar, probably going to end up closing this after the Fed meeting. A little bit of volatility might come out of the Fed meeting, a smidge, not a lot. Maybe I make a couple more dollars, and I end up closing that. Now, for what I'm going to end up doing in my personal accounts, only because the thing is that I think that being able to end up trading this in such a way through the meeting, the insight that I end up gaining, I will tell you, I will take this bottom line here, and I'm going to move it to the zero line, if not higher. I will end up making sure that no matter what ends up happening, okay, I will end up closing my November trade with a profit. But, you know, will I hold it, you know, through the election, not to expiration, but through the election? I might hold one contract and tighten it up a little bit just to end up seeing how it ends up playing. Okay, and so whether you paper trade this, whether you put it on your account, you know, for me, if it's sitting on my personal account and it's there, it's on my P&L, I have to look at it, right? It stares me in the face. If I try to just paper trading it, I know me, okay? I won't do it. I got too many other things going on. So that was pretty much what I wanted to end up showing you on this. Tom, as I go through this, are there questions that had come up here?
There were a few, Jim. Let's see. First one from Paul, when we were talking about the bump on the skew, can you see what strike is at the peak of the bump?
Yeah. Are you looking, Paul, you're looking at the Novembers? It's not as pronounced as it was earlier because we had higher implied volatilities that may, and there's no way, and I've had the conversation with the live vol guys. I wanted to be able to resize this, but I can end up seeing that the bump right here, if you, and right, you hold a ruler, right? Hold a ruler or a straight edge against this, and what you'll end up seeing is that this little move right here, okay, at the 2100 is basically this is not a bump. That's the calls versus the puts. I'm looking at the out of the money because the calls always have a different IV and it's not incorrect. It's correct. This is not a bump. What I'm looking at is more over here. So what's happened is, and it's harder to see on your screen, and it's harder to see here when I put it on my bigger screen. It's much easier to end up seeing. But what I'm looking at is somewhere in this area, and the answer is right around the 2050. Okay, in that, more than 2025, less than 2075. That's the peak area, and then it flattens out. Not until you get way down here, probably around the 1925 to 1950 area. If you take a look at the upside here, okay, it really starts to end up dropping off around the 2150. So what would end up being a really good butterfly to end on to take advantage of this? It would probably be being along the wings at 2150 and 1950, and being short the center at around 2050 or so. It would look something like this. This is why I haven't taken it off. This is the exact butterfly that I have on, that if I was to put on a trade to take advantage of the skew of where it is to go after expiration, it would be this. Now, I don't like as much risk as I have here, so I have to end up modifying this somewhat. But having the long slightly above the money, having that short in that, let's call it that 3% or so, 2.5% below the money, that's where we seem to end up having the peak in this environment. Okay.
Okay, George had a question about the ideal skew curve for Kevlar or road trip trades for entry or exit.
Okay. Well, think about this. Think about what I told you. I will end up giving you the same advice that the head of trading for Dreyfus, a retired guy that I have breakfast with on Sundays, ended up, whenever anybody ends up asking him, because he just doesn't talk about the markets with folks. We talk about it at the table with all the ex-Wall Street guys when we have a breakfast on Sunday, but never to laymen. If anybody asks him, they have advice from me, he goes, "You want advice? I'll give you advice. Buy low, sell high." You want advice, okay, for what's a good environment to end up entering any trade, and I don't care, who it is, up day, down day. Everybody has their different. You want a good on the strikes that you're buying, have low IV, and on the strikes that you're selling, have high IV. Okay, so if you take a look at the curve, okay, what ends up happening is that you can take a look and say, is there a bump someplace? Now, if it's a straight line, it's a little bit more difficult, right? Well, it's not as easy to see where it is. In those situations, what I take a look at is I will take a look at somebody else's trade. And what I'll end up doing is that I'll take a look at what the implied volatility is, and basically how much premium are you selling or you're buying at that strike. So give that a little bit of thought. How much premium am I buying? How much time premium am I buying or I'm selling at that strike? That means if I'm using in the money or out of the money stuff, it really doesn't matter because I'm only looking at the time premium. That's number one. Number two, if I wanted to collect the most time premium possible, where would I look? At the money, right? I mean, that's where the most time premium is. If I come and I take a look at the options chain, let's stick with November because we're talking about November. Let me pull the November chain up here. Okay, and when I end up taking a look at extrinsic value, right? Because that's what we're talking about. Extrinsic value is just time premium. And I end up coming and take a look at the money. Okay, look at my extrinsic value. Where's it going to be highest? At or near the money. Okay, the problem is that the IV here is lower. You see, it's at, let's round it to say it's at 20.5. It's a lot lower than if I ended up selling and saying, well, there's too much gamma risk. So therefore, I don't want to sell contract at the money. Okay, so what do you want to do? I want to do what you told me, Jim. I want to sell a super high IV. Okay, let's go down here and sell a 44 IV, selling the 1675. But you say, but wait a second, Jim. I'm only collecting 20 cents or 25 cents if I do that. I don't want to do that one either because it's too far out of the money. Okay, so what do you want to do? What do I end up looking at? The stuff that I want to end up selling at is going to be at the crossroads. So it's basically going to have the highest IV at the most money that I'm receiving. And there's a reason why if you look at, the Kevlar, the Road Trip, the Rhino, why do they end up having structures that, kind of look similar? Is that they have to get a statistical advantage, right? You have to get a statistical advantage. So what do you end up doing? You end up selling that bit that has the highest implied volatility at the most time premium. Now, here's what ended up happening, and I've spoken to head of options trading for firms that were $1.5 billion, $3 billion. They weren't hedging guys like the EAB guys, and they don't see the stuff that I showed you. Okay, they don't look at the IVs the way we looked at them in a curve. You have to be able to end up seeing what's changed. One of the things that have changed, this year, is that how the curves have morphed in and out of, markets dropping, how the steepness of the line has gotten when the markets have sold off versus when they've been grinding up, how there's been fear at certain parts of that curve. People have ignored the shape of the put skew. And hence, I get some guy who's responsible for hedging $3.5 billion tell me, 2016 has been the toughest year I've ever had, even tougher than 2018. Tells me you're not looking at the skews in detail. Also probably tells me in 2008 you weren't flying the plane, you were probably a passenger and coach for that matter. And so when you take a look at this, you have to be able to end up going through. And now once you have, the insight portion of this, I have this information, I have this insight. Now, how do I end up building a trade to take advantage of it? I'm not going to end up giving you specific trades on how to end up doing that. But I'm going to tell you is that I'm going to have to end up looking at what happened before and after. Okay, and the answer is going to end up being in a structure that I'm going to build. It's probably going to end up being, if we just stick with puts, right? You can build any type of structure you want, but I'll just keep it as some type of a butterfly or a condor type structure. I'm going to be long over here above the money. I'm going to be short in the bubble, around 2050, and I'm going to be long down here. Why? To be able to hedge my butt in case the market ends up going through everything. Okay, so that's the way I would end up hedging things. What would I end up doing? If I would suggest for most of you who are not really, a ton of experience, if you've gone through this, okay, and you've gotten your butt kicked a couple of times, okay, and you think you end up wanting to get and you want to throw one contract on, or even better yet, play in the SPY, not in the SPX, I'd really encourage you to do that. Play with money that you can end up losing. Okay, what you'll end up learning and what you'll see, what they'll fill and what they won't fill. Okay, going through an election is really, really amazing. Okay, I think that answers that. Next question, Tom.
Another one from George. He says, does the skew curve drive the type adjustment done in the middle of a trade?
I would say for most people, no. For me, it's the most critical factor there is. Okay. The reason why, Tom, you haven't been making money in your road trip is that it's exactly, and the exact same thing happened, I'm sure to everybody. I know Paul Demers and I were talking about this yesterday. It's why he didn't make any money at all going the 2 weeks into Brexit. It's why, he closed everything, about a week and a half ago on all of his trades except for the Kevlar, because he knew that he was taking advantage of the skews the way we all take advantage of the skew, and he knew that the skew was going to end up changing. We had the discussion, and he said, you know what? I'm out of here. He went into cash. One of the not the same investment advisor, but I was speaking to a different investment advisor that runs about $2 billion, okay? And they have an expression that cash is a defensive position. If you guys heard me speak last time, I spoke about, one of my dear friends from college, Joe Spinetti, who's always had, battled his weight. And one time when he was, probably about 300 pounds, and people ended up telling him, said, Joe, you really need to get in shape. Joe would turn to him and look at him square in the eye and tell him, round is a shape. Cash is a position. It's a defensive position. You're fine to end up being in. And you know what? It's easy. There's zero stress. It's To me, though, if you're doing this to learn, you can't learn from the sidelines. Okay, trade an trade one SPY contract. Trade whatever you can end up affording to end up saying, I know I'm probably going to get my butt kicked in this. I'm going to see how it's end up going. But the experience that you end up learning from this while you have the trade on will end up being so much more than if you try to end up back testing it with a set of rules afterwards. That's what kind of drives me crazy sometimes. People end up having this back testing set of rules, but they have no rules in and around what IV either is at an overall level. They definitely don't have a viewpoint on what IV is in either skew or maybe they might look at term structure. I was speaking to Don Kaufman earlier today. And when we were talking, one of the things that he had been talking about is look at these lines above that are higher than these lines. Why, when I go and I take a look at, and let me get rid of some of these other things. Okay, if you take a look at the aqua line, right, I can tell you when I look at this, or the sequential dates, I'll tell you something really big is happening in between November, 7th and 9th, okay? Just by looking at this. If you ask me what this was, I would probably tell you it was going to end up being going into earnings, where there's an uncertainty of what would end up happening. Here, though, because they're so steep, it would probably end up telling you it's more of an index. But this is a known event. This is a known uncertainty. We don't know what's going to happen, but we know it's there. So the implied volatility is really, really different, of it. Okay, Tom, next question.
Let's see. Alexander asks, what do you think of keeping the position on and buying a straddle or protective put? And what will you do in December? I think he's talking about your Kevlar.
Okay. Kevlar stuff, I can't end up speaking about Kevlar. I end up showing you stuff because it's not, I showed you what was in November because it's just the very end of it. The December's on. There's nothing for me to end up doing in my current position, and all of our subscribers know. Okay. Would I buy a straddle or a strangle? No, because and people end up thinking, the answer is, let me buy a straddle or strangle. It's too late. Okay, if you wanted to buy a put, you had to buy the puts that I happen to be short 2 weeks ago. Okay, and Tom, that you're probably short, and probably most of you are short. You guys are all probably short somewhere between, less than 2,100 and more than 2,200. Some put in there would have been a great put to buy a couple of weeks ago if you were fearful of being able to do this. At this point, that IV is too high. You can't be buying those strikes. At this point, you need to be selling them. Now, can you end up selling those? Yeah, you could end up selling them. What might one trade end up be? The answer is, what are you trying, right? Please go and watch the hedging class that I did last week, because you asked me a question like that, and I'm saying, what am I trying to protect? Let's go through one example. Let's say if you're trying to end up protecting against some catastrophic fall. Okay, let me get rid of these things, and let me pull up a new window so I can actually end up showing you something. Okay, let me get rid of this one too. Let me come over to here. Tom, what was the next question? So maybe I can end up answering that while I pull this thing up.
That was a question about going over the difference between TOS and live vol skew graphs.
Okay, I'll get there in a second. Okay. So let's say because of where the skew is, I'm looking at this, and what I'd want to end up doing is I'd want to end up hedging, for my portfolio, because I'm afraid that if, Trump wins, or you could do the other one, if Hillary wins and the Dems also take over the Senate and the House, so whichever party you're affiliated with, you can end up playing, your nightmare scenario. Okay, so before you buy your tickets to leave the country, you're going to say, well, how do I hedge my portfolio? Okay, I'm going to take a look at simulated trades. So I know what's ugly, right? What's ugly is around that, 19. Okay, so, this is something I'm going to want to end up selling, because the thing is, it's artificially high, the implied volatility here. So I could do something like this. I could end up maybe buying a back ratio. Okay, and I haven't looked at specific trades to do this, but I would end up wanting to end up maybe coming over here and remember, I'm just looking at disaster meltdown situations. Okay, and if I did something maybe below the whole thing. Okay, let's take a look at what that looks like. Okay, so by buying a 1x3, okay, where I sold the expensive one, I bought something, okay, 75 points below it. It's going to cost me 55 cents. And so now what ends up happening, if the market ends up tanking and volatility explodes, this is going to end up doing well. But here's one of the things people don't realize. The effectiveness of this hedge melts. It gets less and less effective every single day. So if I come over to here and I take a look at, well, not what just happened here. Let's go and take a look at what ends up happening. Let's, I don't know, draw a couple of lines. Okay, that's what I want to see. So take a look. This is the line today. And if nothing happens in price, nothing happens with implied volatility, nothing happens with skew, nothing happens with that little bump, right? It's all of these things. I've made assumptions that nothing at all is going to end up happening except for time's going to end up decay. Look at what's going to end up happening, okay, on the 10th. Now, I granted the 10th the day after, so I'd want to probably look at it a little bit before that. But here's what's going to end up happening. Now, what's going to end up happening afterwards, the implied volatilities are really going to end up messing this thing up. So if we end up coming down 3, 4, 5%, this line is probably going to sag, and I'm going to end up losing money. Say, Jim, I thought you put in a hedge. We were down 5% and your hedge didn't make anything. Yeah, I know. This was a disaster, okay, one where I'm one of those conspiracy theory guys, or, I'm the, again, I don't care what your politics are, but whoever, you don't like, okay, ends up winning, and therefore the market's going to be down 20%. That's what you believe? Okay, I'll end up taking a look at this one, and let me make this minus 20%. Let me just redraw that. Oh, it's already there. And you can see I'm going to make a ton of money. Right? I'm going to make a ton of money. Okay. Now, it depends on what's a good hedge. What do you want me to protect? Okay, I can protect. Okay, I got to know what I'm protecting. Over what period of time and against what? Okay, it goes back to, you remember the reason why I kept one slide from the previous hedging class that Paul and I did, and that one slide was protection, okay, of insurance versus hedging. We end in that slide. If you go back, okay, if you watch this thing again, there's a link, okay. What we end up having articles, okay, that are put up on the public site. Joanna White wrote one on the difference between, or the similarities between, insurance and options, if you think about hedging or your positions. And it's a really good way to think. It's a really, really good way, because you guys make those decisions all the time. And so you're basically weighing the trade-offs. What am I buying? What am I getting for it? Okay, Tom, I'm looking at the time, so I want to end up answering as many as I can quickly now.
Just talk about the difference between TOS and live vol skew graphs.
Okay, if I come over to okay, the problem with the skew graphs on on Thinkorswim is that you don't have the granularity. You can't blow them up as much. You can't end up looking at a specific number of strikes. And so there really is no way to see the visual difference. If I can't see the visual difference in them, they kind of become useless. They kind of become a nice toy. If I can see where those bumps are, then the tool becomes useful for me. So what I have to end up doing is I have to end up going and putting, okay, the live vol one on the biggest freaking monitor you've ever seen, okay, and being able to end up, freaking almost holding up a ruler to it to be able to end up taking a look at the difference. Can I end up writing a tool to be able to end up taking a look at it? The answer is yes, I could, but I'm not going to do that unless, somebody else is going to end up giving me a development budget, because it's going to take a lot of time and effort to actually end up doing. And you're not going to be able to end up, okay, writing something that's going to end up, okay, protecting against everything. You kind of have to be able to end up seeing, understanding. Right? It goes back to what I ended up saying before. These are data points. Engineers love data points. Okay, I'm not talking about data points. You need to put the data points together, okay, to get information out of them. Once you have the information, you have to be able to end up saying, well, what do I do with the information? And that gives you the insight. You have insight when you trade options, you will make money over the long term.
Okay, Dot asked a road trip question about hedging, either using a global put or debit spreads. Dan and I tend to use debit spreads these days for several reasons, but she said if you did use a global put, how much would you cut the deltas for a global position if it's composed of multiple expirations? We just like to cut it by in half to two-thirds.
Okay. I have not made my points, okay, in this whole presentation with questions like that. I'm sorry about that, Dot. But what I'm saying is that, yes, it's a good question from a rules point of view. But what's not a good question is you have to end up saying, where would I end up buying it? Okay, if I bought a vertical, okay, buying what would have been a typical vertical where where my long call, right, buying a typical vertical where my long put would end up being in this area that's overextended and higher, and then selling one that's normal over here would be terrible. Okay, would it be better off maybe buying a put vertical over here where we've gotten much deeper, where I'm buying something above the money and then selling some? That will give you statistical advantage. Okay, are you willing to end up saying, well, I don't care about statistical advantage. I'm just going to end up doing this. You're not going to end up having the same level of profitability. You're going to give up profitability. You're going to have more times that you're going to have to end up taking a loss. What I'm trying to end up doing, okay, in this video is giving you the tools to be able to end up saying, here's the analysis you need to do to be able to have statistical advantage. If I make an adjustment, okay, or if I end up closing my trade, and I end up putting on anything through expiration or I have to hedge anything through not expiration, through the elections, it will be something that I will have statistical advantage on, where I will be buying a lower IV and selling a higher IV than normal.
Okay, and David has a question. Any thoughts on taking the other side of a period leading up to a defined binary event, like selling negative gamma, short theta, long vega butterfly, and short long call trade?
Oh yeah, without question. You can definitely end up doing this. But again, I had a long conversation multiple times during the last week, because everybody ends up thinking, and this is what you learn, okay, when we're all, options, okay, newbies going to, first grade option class, is a long volatility trade is buying a straddle or strangle at the money. So we're long volatility and we're long gamma, but we're going to have to end up paying the price for that in time premium. So do I end up doing a simple, okay, buy volatility spread, okay, back ratio? And the answer is that's the basic, okay. Guys that are my Kevlar subscribers, I am obsessive about my gamma. Okay, when my gamma goes negative, I hate it. I absolutely hate it. I do everything in my power to keep my gamma at zero or positive. And people say, well, if you're a positive gamma trader, therefore you must end up having to pay for it. No, I don't. Okay, I collect my theta. Okay, so the answer is, if you just look at this from a simplistic point of view, yes, you're going to end up buying spreads or selling spreads. If you look at this, okay, and you're trying to truly gain insights, you're going to be able to end up putting together combinations where you're selling higher. What do I do? It's very simple. All right, I sell higher IV and I buy lower IV. Not IV as a percentage itself, but IV times, okay, basically a function of IV and the extrinsic value that I am getting. That's the key to it. That's the key. Okay. Once you understand, okay, the key to that, and you practice. Oh, by the way, understanding it and mastering it is probably about a 10-year process. At least it was for me.
Let's see. Andy asked a question for deep in the money puts. IV is very high, but dollar amount of time premium is very low. How do you quantitatively find the best combination of high IV and high time premium?
That's a really, really good question. And the answer is it's experience. You can end up building formulas on the stuff, but every formula that I've ever built wouldn't end up working. But it's basically going to be some combination of the crossroad of the highest IV I can end up getting with the least amount of time premium, and then being able to put together the different strikes to be able to end up saying, how do they end up functioning over time as IV, skew, and skew shape will change? Okay, it's not an easy. There's no exact answer. I don't have an exact answer for you. It was experience. I will tell you that in general, okay, and you guys already know this. Why? Because the short strikes of the road trip trade, the Rhino, Amy's stuff, even though she's using Iron Condor, she doesn't have a single point. She's got 2 points where her shorts are. Anything I've ever seen from John Locke. They all are everything. By the way that EAB builds their hedges for institutional clients, okay, I'll tell you, they're all the same. They all are selling premium. 1 to 2 months out, maybe a little bit more, and they're all somewhere between 3 and 6% below the money. You got to be short those strikes. Now, in a perfect world, I remember, my friend Stephen Shannon said, well, in a perfect world, we would just sell those. Okay, we wouldn't have to buy anything. Well, it's not a perfect world. We need to hedge it. So what do we end up hedging? Now that's where all of the different trades that I mentioned are different. What strikes they buy, how they manage their risk. But I end up doing the exact same thing all the time. What I'm looking to do is that if IV is higher, I'm going to want to have trades that are shorter Vega. If IV is very low, I'm going to want to have trades, and I can't get my trades to be positive Vega. I mean, I'd love to, but I have them be as short as little Vega as possible. And those are the design principles, right? This is the insight. I mean, this is truly the stuff that you write, your PhD dissertation on. This is not grammar school stuff if you learn that and end up doing it. The problem is that, I've been asked, I was speaking to some marketing guys who, I give them a ton of credit. They're a lot better than I am. I mean, they've raised $1.5 billion, okay? Too complicated. Well, you know what? Yeah, rocket science is. I know that. Sorry.
Well, Jim, I think we've pretty much run out of the questions and time, so this is probably a good place to stop.
Okay, good. Guys, I hope this gave you some peek into what you need to do to be able to end up getting the insight to become a real professional trader. Like I said, this was not for newbies. If I went over your head on some things, I apologize. Watch it again. You guys, maybe if you want, I can end up having a follow-up session on this. This becomes the most critical, not just in hedging, but in trade design also. So thanks for listening. Hope you got something out of this, and we'll talk to you soon.
Okay.